Good morning. This is the Arlington County Board of Equalization hearings for Tuesday, July 7th, 2020. The first case on our agenda is an economic unit. The RPC is EU 2800402A, 1000 South Frederick Street. We have Mr. Nathaniel Root and Mr. John Kinney speaking on behalf of the appellant. Gentlemen, I don't know who's going to start, but you can tell us about the property.
Jonathan Kinney will be presenting for us today.
Okay, thank you.
The Columbia Hills property contains a total of 229 units. We're appealing today the increase suggested by the county, excuse me. Well, it's a 24% increase over the 2019 assessment for a total of $7,295,000. These properties are all at 60% of median income or below. The Columbia Hills property actually has 54 units that are either at 50% of median income or 40% of median income. Obviously, the lower rents, even below the 60%, affect the income potential of the property. For example, a 40% efficiency under the figures that you use for calculating rent would rent for $791, while a 60% efficiency would rent for $1,213. New figures may be higher because the 40% efficiency would be at $850 and the 60% efficiency would be at $1,275. But what that occurs is that the gross rent potential is being overstated by $205,400. And we believe in this particular case, the expenses, the operating expenses are understated by over 10% or $72,400. One of the other issues that we have on this is the vacancy allowance and concessions in Columbia Hill West. Columbia Hill East was basically stabilized during most of this point in time. But our position is that under the statute that relates to affordable housing, that these properties should be based on the actual income received, which is obviously affected for the next 60 years. And I don't think the county is contesting the affordability or the 60-year period. So we're really discussing the difference between what we believe was the actual income and the actual expenses during last year and how to treat the vacancy allocation. Our feeling is that under the statute that since the property needs to be assessed under the income approach, it doesn't say stabilized income approach. It basically says income, and the APA position is that this particular property, we just basically need to look at the actual income and expenses, put the cap rate, we're not arguing with the cap rate, put the cap rate on that number and come up with the assessment. Thank you.
Okay, thank you. Mr. Bailey for the county, please.
Good morning, board. I'll be representing the commercial team for the 3 residential, multifamily properties that we have owned by APA today. This property is Columbia Hills. As Mr. Kinney stated, the property was recently constructed in 2016. They finished construction in 2018, around October, I believe it was. We were able to go out during that time period and do an interior inspection of the property to see what amenities they had to offer and what the overall condition of the property was. 2019 was the first year that the property was leasing up. So naturally, during the lease up period, the property would have higher vacancy rates. If you look at the I&E submitted, I think it is page 1. The I&E submitted for, page 332 of the packet. You'll be able to follow me. The I&E submitted for 2019 income and expense information. this page states the vacancy over the last year and over the current year. The property owners breaks up the entire property by east and west. So page 332 reflects the information for Columbia Hills East. So the vacancy over the last year, which would be 2019 for Columbia Hills East, was 2%. And the vacancy as of January 1 is 3.1%. If you go to page 334, you'll see the same information provided for Columbia Hills West. As stated last year, 2019 was the building's first full year of leasing up. The average vacancy for Columbia Hills West over the entire year of 2019 was 32%, but you will see as of January 1, the vacancy was actually 1.5%. So as of January 1, the overall vacancy for the building was in line with what the county used of 3%, which is the guidelines for affordable housing. The appellant did contest the value last year, and during that time period, the county reduced the assessment. That assessment was reduced down to $30,099,700. This was a reduction that was derived at the department level. The owners signed off on a reduction in 2019. Here we are in 2020, and they're asking for a value of $20,822,800 for a building that has went through 1 year of stabilization and is now occupied at least by 97%. During this review, the county did look at the information provided. We made some recommendations by making adjustments to the We made adjustments to the rent revenue and some adjustments to the expenses based off the information reported to us. This is on page 5. And that revised value was $36,453,000. And the appellant rejected the assessment reduction, but that is what we're asking the board to set the 2020 assessment at. Another thing to point out again is that the difference between 2020 and 2019 is during 2019, since the building was undergoing lease up for the first year, which is common for new construction or newly constructed multifamily property, we deducted 12 months of lease up on this property in 2019. So that's also one of the differences. So that $30 million is after the 12-month lease up deduction. Some of the things to point out is that if you look at the overall packet provided by the appellant, the total cost of this building was $89,428,000. For us to be able to value based off the low income rents of $36 million, I think you can definitely see what we're taking consideration, those affordable rents. Some of the rents that Mr. Kenny pointed to on the efficiencies were actually higher than what we used on our test column, not by much, but I mean, it just goes to show that we are looking at the actual rents they can achieve. We're looking at the expenses that they're reporting to us. Our expenses on the test are much more in line with what they've reported to us, and it's in line with other properties that's owned by Apple in the county, especially when you consider that this is a brand new building. So again, we ask that the board confirms the test value, which was the original reduction offered to the appellant of $36,453,000. That is all we have. We're available for questions.
Okay, thank you. Questions from board members? Mr. Lawson.
Can you hear me okay?
I can.
Okay, I have two questions. First for Mr. Kenny. John, on, let's see, 58.1, 3295, number 1, says the contract rent and the impact of applicable rent restrictions. Wouldn't the contract rent be the rent that has been contracted to be received this year?
I think those numbers between 2019 and 2020 are approximately the same because of the rent restriction amount.
Yeah, I
That
guess what
doesn't
I'm
mean
getting
they
at,
don't, that doesn't mean that they receive that amount.
right? I guess what I'm getting at is, you all are going with the vacancy of last year, when this year it's just about fully rented, and I'm not sure the statute provides for that.
Well, the statute doesn't say the income method based on stabilization. It says the income, the property, and I think that is our position. The income in 2019 is exactly what we're showing.
And the statute, when it says income, that in your read of the statute, that means look at last year and go with that, even if it's no longer accurate. I'm not giving you a hard time. I'm trying to understand how you're interpreting this statute.
I believe what happens is that parties do look at the previous, because that's why you file an income and expense statement. You do use that, and the county generally uses that as the basis of valuation.
Okay, I got a quick one for Mr. Bailey. Mr. Bailey, how come you didn't go with the applicant's expenses? They say that you're understated it by $72,400.
Are you referring to our test, or are you referring to?
The applicant is saying somewhere.
If you look at our, sorry, if
No,
you
they're
look at
saying
our test column, start there. So that's what we're saying the value should be. So start with column F and look at the
okay, I
expense.
got F. See, they're at 1 million. God, it's hard to read this. This is so small. You're at 2,150,000. They're at 1,228,000.
All right, so we're gonna refrain from stating income numbers, and I'll just point to column F, line item 18 is the total operating expenses. So if you look at column E and column F together, you'll see that we're very close. And again, when they state that we under projected, we didn't have 2019 information when we made these projections. We had column C, which is 2018's partial information, because again, they began leasing up in October of 2018. So the information reflected in 2018, the column 2018, which is column C, is for the month of October through December. We made our projections based off of guidelines and of affordable housing. And that's even by that method, I mean, you can see that we were still pretty close to what they achieved in 2019. The
Right.
test goes further to be in line with what they reported for 2019 because it's just more recent data. Again,
Right.
2019 information. Go ahead.
The statute says go with actual expenses.
Well, as we said plenty of times before the board, I mean, we don't go dollar for dollar. We don't believe that's what the statute is saying, that you have to go dollar for dollar. It's you take in consideration the impact of the expenses that these properties incur. So a newer property that's affordable, that's built in, say, 2016, such as this property, they will have higher expenses than a new market property built during the same time period. They would have lower rents than a market property built during the same time period. And that's why we look at the affordable guidelines, which is derived from the income and expense form submitted by all affordable housing in the county. APA, AHC, and Wesley Housing are some of the companies that operate affordable apartments in the county, and they also are some of the much appreciated, but the people who submit 100% of their income expense form. So that's why we do stand by our guidelines, because we know that affordable housing properties do report for all the properties that they have.
I'm taking time on this, Madam Chairman, but I think all three of these cases kind of have the same thing. Mr. Bailey, but the statute says the actual operating expenses.
Shall be considered.
Right.
And we considered the actuals. If you look at, again, columns E and F, I think we're about $5,000 apart. Actually, we're a little bit, we're around $4,800 apart on the expenses.
Right, but you're further apart from G, which is, they're saying it's $1 million, what is it, $1,512,000?
G.
Yeah, that's what they submitted.
Well, their pro forma expenses don't even match the 2019 expenses. They're actually higher.
Right, they say it was understated by 72.
But their pro forma expenses aren't actual expenses. The column E is the actual expenses.
Well, let me ask the applicant, are those actual expenses or estimated?
Nathaniel?
I'm taking a quick look right here because I believe they're supposed to be actual. I'm not sure why they wouldn't be matching the I&Es. Let me take a quick look to what we submitted. Sorry, let's see. One 51288. So I have on my end 1512858 as total OPEX. I'm not sure why that's not jiving with the I&E. Let me see if I can pull that up real quick on my end. If there's other questions, you can continue with those. Let me see if I can track this down real quick.
Okay, I have a question, Mr. Bailey. I don't have as much angst over the expenses because, I think from the test, based on the 2019, I think that, 4,800, I can live with that. My concern goes back up a little higher on the chart here, with the actual rents. And I can see where you're trying to stabilize even an affordable housing complex, but this is really the first year. So I think if in a year, the actual income that they're getting probably plays the most importance and the most realistic. And, from a standpoint of, where Mr. Lawson asked earlier, well, should we consider that if that's not necessarily the case moving forward? That's how we do assess properties. We look at the actual income reported for 2019. So from a standpoint of equalization, I think 2019 numbers are very relevant. But I'm just concerned when I look at, I guess it's line 11, you stabilize the vacancy, but when you look at the difference between what you're projecting versus what they actually received, and I think the code does say to consider actual income and expenses, I think there's more disparity on the top half of the chart than on the bottom half. So I just would like to hear from the county on that.
Again, I think we kind of stated why we wouldn't go with the 24%. If you look at their I&E form they provided, they said as of January 1, the vacancy was around 3%. So when we look at the information we're projecting for 2020, we're not looking at 2019 anymore. We're using 2019 to test our projection. And so when you look at column D, we made a projection for 2020's potential revenue, 2020's potential vacancy, and 2020's potential expenses. We only had 2018 to go off of. Again, that information was only for October 2018 to December 2018. So it wasn't much to go off of, and we relied more so on the guidelines. 2019 was submitted to us this year. We looked at the income statement from 2019 and tested that against our projection for 2020. So again, the vacancy dropped from 77% in 2018 to 24% in 2019. So our projection of 3% in 2020 is fair. And again, it's supported by their own information provided to us on the I&E that stated that the Columbia Hills East vacancy as of January 1 was 3%, and Columbia Hills West vacancy as of January 1 was 1%.
Okay. All right, thank you. Mr. Matskin, I think you had a question?
Yes, I thought you were going to ask it, but truly Mr. Bailey brought it up and dropped it quickly, and that's on the vacancy and related numbers, concessions, foregone rent, where it stated, as Mr. Bailey brought up, about 3% for the entire project, but those figures were picked up entirely, I think exactly from 2019 to 2020, was it 24% plus? To me, that's the big number to look at in the disparity between columns F and G. Could anybody from the appellant describe why, after the lease up in 2019, you're still having all this vacancy issue as reported in column G versus the 3% that you report in your submission to the department?
So I can answer that, John, if that works.
Sure.
So when we submit the I&E reports and when we submit the appeals, we don't have operating data on 2020 at that point. So we typically are appealing based on a year lag. I think this is answering the question. So we don't know what the full year is looking like outside of budget assumptions. So our appeals always focus on the previous year. So we're always going to be appealing based off of 2019 valuation.
Just as I expected. Thank you. That's reasonable. Thank you.
Sure.
But just to follow up, Mr. Root, on that, I mean, so you didn't have, obviously you didn't have the 2020, and it's not relevant to this, but you did have the 3% vacancy as reported. So, you know,
Yeah,
I assume you did this paperwork in, you know, early January, February, somewhere in there, maybe even March.
Yeah.
So why is it still up so high?
So, and again, it's back to we're appealing based for 2019, and it's based on my understanding with how taxes are assessed. It's essentially in 2020, you're paying for what you did in 2019. And so that's why we appeal based on full 2019 dollars. And if that's a misunderstanding, then we can talk about that. But that's why we appeal based on that valuation, and also the fact that the building is leasing up, and so our realized value of the property is lower, in our opinion, than what the county is saying.
Okay. All right, thank you. Mr. Huffman, you got to unmute your microphone.
Okay. I actually have three questions, but going on what we were just talking about, what would the property owner's opinion be on the long-term kind of structural vacancy for this building when everything's stabilized?
Sure. So I think it's reasonable to expect somewhere around 3%. I think that's typical for our portfolio. So once the property is stabilized, I think that's a totally reasonable vacancy to be using on this property.
Okay, thanks. And then there were a couple lines. There's a rent concessions at $180,000 in 2019. I'd like to understand what that is. And then also both the department and the appellant did not have any income for parking, but you've got another income. So I think there's 200 more or less spaces. Is the 69,000 for parking, or was that something else?
Sure. So I'll start with the question was about concessions. So what happens is that for affordable properties, we need to get residents in order to get the tax credits by a certain deadline. And that makes sure that the property stays solvent. And so what we'll do is for residents that don't have the right timing, so if their lease goes a little bit like a month or two longer, we'll give them a concession on if they sign the lease early so that we can count that unit as occupied. In terms of other income, I would have to double check on that one. I don't know off the top of my head if that's specifically parking related.
Maybe Mr. Bailey can answer it. The 69,000 in other income?
Let me double check as well. Yeah, so we typically don't charge affordable housing for parking. It's our understanding that a parking space comes with the unit. So we typically don't charge or even see parking income on a lot of affordable housing. We notate how many spaces they have, but we don't attribute any actual income to those parking spaces.
Okay, so there's no parking income. I see Mr. Kenny was nodding as well. There's 200 spaces with no income. Is there any covenant restricting charging for parking, or that's just kind of best practice?
I think it depends from property to property. I don't know necessarily whether there's any covenants restricting it at Columbia Hills. I think it depends on whether the parking is in basis or not.
Okay.
So what we have seen is that if there's a mixed use building where there's some affordable and some market units, the market units are charged for parking, but the affordable units aren't.
Okay, thanks.
Okay, any other questions from board members? No? Okay, Mr. Bailey, if you take a minute to wrap up, please.
Okay. As we stated and the agent has stated, this case comes down to the vacancy. We're comparing the vacancy as of 1/1, which is around 3%, to what was achieved or incurred on the property for all of 2019. Something to remember is that the 24% being reported for 2019 is from January through December. So it's the lease up period vacancy. It's not the vacancy of the property after the lease up. And even at the agent's own admission, how they expect this property to perform. That's why we use the 3%. We used the 2019 test to test our projection. Based off of that 2019 information, we made adjustments to the revenue and we made adjustments to the expenses, and we came with a lower value that was offered to the appellant of $36,453,000. The first year lease was actually 2019, and that assessment did take in consideration that it was under his first year lease up, and that's why we deducted the 12-month lease up deduction. That is all.
Okay, thank you. Mr. Kinney, would you like to take a minute to wrap up, please?
Sure. I think the issue is not only the vacancies and such as that. There is a difference in the income being, in this case, we believe it's being overstated and the expenses are being understated. Our position in terms of the vacancies and such as that, it is that the statute is, in our opinion, is fairly clear that's based on the formulas used. So for 2019, we had that vacancy rate. We recognize that next year that won't be there, or most likely won't be there. Of course, if I had a retail property at the beginning of this year and somebody made an assumption that my rents would be the same this year as they were last year, I think we'd all, recognize that things can change. But bottom line is, our feeling is that the county uses the 2019 numbers for fixing assessments, and in this case, they have basically not using that. They're using. I'll end.
Okay, thank you, sir. All right, it's just among the board members. I have a thought, but I will wait to hear what some other people think. Mr. Matzkin? Turn your microphone on, please.
Forgotten to turn it off. Thank you. I am still focused on the very obvious vacancy and related dollar figures to that. difference between the department and the appellant. And I think, based on what I know, that what can be known on January 1st, in this case 2020, needs to be disclosed. And although all the final expenses certainly weren't in for the appellant, other expenses for 2019, the vacancy rate was quite well known by the appellant, and they did very, very well in their improved property by leasing it up very quickly in the end of 2019. And I find that biggest number, that biggest disparity, vacancy and related, to be relevant and appropriate as depicted in column F. And to me, that's the big difference, and I support that, and therefore I support all of column F.
Okay. Other comments? Mr. Yates.
Well, they admitted that 3% is affordable, is their number. And they knew that was coming, and they knew that's where they'd be. But I guess, and my mic cut out, and I'm sorry, if someone can answer what was said during the gap I slightly had, or my speaker, concerning concession. What was that about? I kind of missed that answer. That was one of the questions I wanted to ask.
I think I heard it's free rent, some sort of incentive to get the applicants to get their paperwork in fast enough so that they can meet their financing requirements.
For tax credits, yeah.
Okay. So it's not a reoccurring kind of scenario. All right. That's all I had. I'm pretty comfortable.
Yeah, I guess where I'm at on this, especially since this is the first year and we assess based on the previous year's, income and expenses. And I think in this case, we're kind of in a quandary because it did have some unusual expenses to get it leased up. I think myself, the code allows us to consider the actual income and expenses. I mean, if you're comfortable, what I did was I took the actual stated income from the appellants, but then I used the 3% because I think that does kind of put everybody more on a level playing field. And, the appellant did say that probably is the stabilized vacancy for them. And I think in today's market, even more so, once people get in, they're not going to be moving out. I mean, this is a tough time to be relocating to new apartments. But that being said, and then looking at, the adjusted expenses in column F, I end up at 34,244,800. And I'm not saying that I don't think it's worth more. I think it will become worth more in the future, but this is the first year that they leased up. That's just my concern. Mr. Lawson, you had a comment?
Yes, ma'am. I ended up at around 32,000. But
32
I like
million?
your explanation, and I would support where you are.
Okay, Mr. Yates has just got bumped off again. And although he says his vote is to confirm what's on there. So what's everybody else say?
Well, Mary, I know that a lot of times we think alike and we work numbers almost the same. Originally, I thought the same, using the actual income. But I'm a little bit in the line because I think the rents that were used by the county were appropriate. And, we've done this many times. We use the actual income and expenses. We look at the income and expenses statements, but, I really don't have any trouble with the income that they have. But originally, that's what I did. I used the actual income that they reported. But I think you're a little bit lower than I am. What number? I know that we're not going to be looking at numbers, but which line did you use for actual income on the appellant?
I use line 7E.
Okay. Well, I did the same. I used that line, and I used 3% for vacancy, and 41% for expenses, but I come up with a final number that is higher than yours.
Right, well, probably the reason is you went to 41% on expenses where I used the actual hard number because I think the hard number is more in line with what was reported.
Oh, okay.
You know, and it's slightly, I think Mr. Bailey had said it's like $4,800 more than was actually reported. So I felt that number was pretty solid. That's how we came up with that. You know, and again, I think 2020's numbers are going to tell a different story because I think it is going to be far more stabilized. But, you know, for my money, I think that we should be looking at what actually was done in 2019 for this, since it is the first year.
Mary, can you repeat the number you came up with?
The final number, 34,244,800. Mr. Hoffman, where are you?
You know, I think these are really difficult because they're such complicated deals with the covenants and restrictions and all the different financing and everything. But I think Mr. Bailey did a really good job of kind of pulling apart the essence of it. And I don't even really see how anybody could argue, or at least has made a compelling argument to change the department's recommended value. So they haven't really moved me that the value of this property is significantly less than $36 million, given that the vacancy is where it is, and nobody seems to foresee a future where this building's not full. Otherwise, I don't think APA would be continuing to build these properties.
Mm-hmm. Okay, Mr. Lawson?
Yeah, I would just share with Greg, our guiding instructions are the statute. And, I just feel like we have to go with actual when we can. Mm-hmm. And, the applicant indicated that on expenses, they just didn't have them because the county required the filing to be done early. And so when they do get the actual, I think the county, has to consider that. And in statutory interpretation, consider doesn't mean think about it and then ignore. You have to actually utilize it.
I mean, Barnes, we're still looking at 100% of fair market value, right? That's what our job is. There's equalization and there's 100% fair market value. Or is that different for affordable properties?
Yeah, you go with the statute. You have to follow the statute, which talks about actual income, actual expenses. And so you use the income approach, but when you get done, you may be under market, because remember that marketability of this is impacted by all the covenants and restrictions on income. And so, fair market value really doesn't exist with an affordable project.
Right, and that's the reason that they changed the statute to do that, because 10 years ago, they didn't do that. Right.
I think the boss did it, didn't he?
No, he did not do that. No.
Well, I have to disagree. I don't think we have to, just because it says that, we have to consider it. And I think the county does look at that point, and they do that. They do consider it, but, like I said, I was a little bit on the line, but I think I'm okay with the revised assessment as it is right now.
All right, Mary, where are you?
I think I'm with you and going with the actuals.
Okay, Mr. Matzkin?
Same, exactly the same.
I would say one thing, if we're going to go with actuals, that I think the cost of capital on this project was like 1.5% is the loan. And we're talking about financing and cap rate and things like that. 5.9% cap rate for an affordable project that's going to essentially be 100% full with below market rates and has very little market risk and a non-recourse assumable loan seems a little high. So if we're looking at actuals, I think you probably want to be looking at any other projects like this that have traded, and not be comparing it, in a cap rate study with market rate properties that have substantially more market risk. So, I mean, I would expect something like this to trade below a 5 cap rate if it was actually on the market, if Apple went and, marketed the property for sale. So if you're going to look at actuals for 2019, we should also look at actual cap rates for 2019 for any properties like this.
Greg, this is Barnes. I'm just trying to figure out how cap rate interacts with, I think these projects, John, I think they sell tax write-offs. Is that right, on the market?
John's not part of this conversation right
Oh,
now.
that's right. Okay. But I think it's impacted by tax write-offs that are tax credits that are being sold as well. So, I mean, we could spend days probably trying to analyze an affordable project.
Yeah, and I think Irving did a really good job of it. That's why I'm going to side with his opinion.
Right, and I think just to clarify that on the cap rate, I mean, the county does have a different cap rate for the affordables as opposed to the market. And in this case, as Mr. Kinney said in his testimony, they're not questioning the cap rate. I mean, I think from a standpoint of equalization, I would not want to move the cap rate for this affordable when all of the affordables are at the 5.9. So I'm fine with that. So
I am too.
So I'm going to make the motion and see, and if it doesn't, it'll revert to the revised county, but I'm going to move to reduce the assessment to $34,244,800.
I'll second that.
Okay, so I have a motion and a second. All in favor? Aye.
Aye.
For opposed?
Aye.
Just
Aye.
Okay, so no Jose, Mark, and Greg. Okay, the motion carries. The assessment's reduced to $34,244,800. And that is based on the actual income stabilized at 3% and the county's revised number for expenses. Okay. Moving along. Okay, the next property on the agenda is Economic Unit 0900507A, 5708 11th Street North. Just make sure everybody's got the right case up. Okay, Mr. Kinney, if you'd like to start with your 8 minutes and tell us about the property, sir.
Thank you. The Fisher House 2 is a compilation of 8 buildings and 68 units in the Westover area of the county. All of the units are rented at 60% of median income or lower, some under 50%. The assessment over 2019 is requested initially by the county was 64% above the 2019 assessment. Under their revised opinion, it still represents an increase of $3,094,100. Their original request was for $4,059,200. Again, in this particular case, we believe that the expenses are understated by $62,375, which is about 18%, as correlated to the total expenses. Again, this property is restricted for 60 years. I think 57 years remaining or such as that. And I don't think anybody's disputing that. I think what we're basically, the dispute is mainly in this particular case over the expenses and such as that. And one of the things that just came up in the last hearing, when the county gets their figures on most of the affordable housing projects, most of the older affordable housing projects in the county were all at 60%. It's only been in the last 5 or 6 years that the county's made an effort to get down below the 60% median, get to the 50%. So when we're using an average, we're using not necessarily, my understanding is county's not using an average of the 40, 50, and 60% projects. They're using an average of the 60%. And as I tried to indicate last time, there's a great deal of difference between the income achieved on a 60% property and a property that's mixed between 50% or 60% or 40%. In this case, it's between 50 or 60. So when we use comparables, you're using higher comparables than the current market. What's happening now is we're deeply subsidizing these units, and that's the county's request. And APA and the other nonprofits are more than willing to go along with it. They see the need for this. But the correlation when you're using statistical averages needs to correlate to the 50, 60, and the 40%, not just the 60. And most of the income and expense information they're receiving are on the older properties, which are that way because of the initial affordable housing projects in the county were not at 40, 50, and 60. They were all at 60%. So what we're asking here is the property be assessed using the income approach and the actual income, actual expenses, rather than using some standardized formula for expenses. Thank you.
Thank you, sir. Okay, Mr. Bailey?
Yes, this property is a property that we've heard over the past 2 years. APA Westover was purchased by APA for around $16,500,000. They later vacated the buildings because these buildings were market buildings. They vacated the buildings and recorded a restrictive covenant in which they recorded another deed for around $9 million. Upon them buying the property, they decided to renovate the property based off of the tax credits that they received and to be in conformance with VHDA and other regulating bodies of low-income housing properties. When they decided to vacate the building and renovate the property, they submitted an application for a rehab exemption through Arlington County. We did a pre-renovation inspection of the property to ascertain the condition of the building and what work was going to be done during this inspection as well. We talked to Mr. Nathaniel Root during this inspection. The board heard this case last year because the vacancy shot up to around 32%, or what's showing. So it shot up to 32% in 2017. In 2018, it shot up to 72%. This is all because of their decision to renovate this property. The renovation was completed last year. Mr. Chicas went out and inspected the property to see what renovation work was done, what changes were made, and he made notes of this. This is all part of the rehab exemption program. Last year, after his post-renovation inspection, we went over the changes to the building, the condition. We talked about the unit mix breakdown, any changes that would be important to the rehab of the property. You'll see on page 12 of our packet the actual calculations submitted by Mr. Chicas and myself to determine whether or not this property qualified for a rehab exemption based off the work that they did and the condition of the property from 2019 when they applied, not 2018 when they applied, until 2019 last year. We made adjustments to the effective age based off the work that they did. And all of the changes that we saw resulted in a increase in the value that qualified them for the rehab exemption. You'll see on page 12, we had a 2019 value of $8,528,000, and I think that date is actually wrong. That's the post-renovation value, pre-renovation value, so I apologize for that. So the pre-renovation value was $8,528,000. The post-renovation value, based off of the work that we saw and the income expenses, the income information we received, was $10,373,500. So the tax abatement awarded was $1,845,500. That abatement is in place for 11 years, and then just like other rehab exemptions in the property, it begins to decrease the remaining 4 years by 20%, the 12th year, 40% the 13th year, 60% the 14th year, and then finally it decreases by 80% in the final year. It's a 15-year rehab exemption. So this information was communicated to the owner. We communicated, what the pre-renovation value was and what the post-renovation value was that we came up with based off of our inspection, and detailed the awarded amount of the rehab exemption. As you can see, based off of that and the vacancy numbers in the summary sheet on page 4, the vacancy increased due to renovation. They were still undergoing some renovations in 2019, so therefore the vacancy decreased, but you still see it around 12.6%. This was communicated by the appellant that some work was still being performed in 2019. That's why the vacancy is so high. We did make adjustments to our expenses. On this case, we felt like the revenue that we use is in line, with the potential income we use is in line. If you actually compare column F and column G on page 4, the pro forma and the test column is very close. Again, this case comes down to vacancy. They're using the 14.7% that was achieved all of 2019. However, the vacancy actually dropped due to those units that were still under construction being completed. They reported on their 2020 I&E that as of January 1, the vacancy was down to 7%. So again, this property was valued based off of the information that we received. We took into consideration the renovation. That's why the effective age was increased to 1990. Based off of the scale of the work they did. The vacancy, I think the cap rate used last year was higher because last year's assessment did not take into consideration any of the renovation work that was performed on this property. We valued the property last year based off of its original condition pre-renovation. This year, the first year that this property is being assessed with the renovation that was that the property underwent in consideration. So keep that in mind. Is
that it, Mr. Bailey?
Yes, that's it for now.
Okay, thank you. Okay, I have a question for you, and this will sway me on where I'm going with this. But when I look on the I&E summary, in both the original assessment and so in column D and column F, you've taken the rehab exemption off of that, and then the final value are those two values, correct? That show on the grid?
Yes, we take the total value, then take out the rehab exemption.
Right, because on the front page, you've got that you're looking for proposed those final amounts, and it includes it. So I believe the front page is incorrect.
No.
What am I looking at wrong then?
So in the past, what we used to do is we would create a whole separate parcel to hold the rehab exemption. It was a dummy parcel. Due to some changes made, I think it was by code or whatever, we have to show the total value. So what we do is we show the total value of the property, and then we put an asterisk that says that the rehab exemption, which is tax exempt, is included in that total value.
Okay, all right, so look at page 1.
Okay.
And again, pardon, it's hard because I can't ask the question, but so when I look at department's recommendation to reduce the economic unit, you've got a proposed 10,458,300.
Yes.
That's public record, so I felt I could say that. Okay,
Okay.
and that you're saying that includes it. Yet when I look at the grid, the I&E, you've got that coming off of there with a final value of a different number. Do you see what I'm looking at?
Yes. So what I'm saying is included in that total number. So that 1,845,200 is included in the 10,458,300. Not on
Why
top.
is the final value here different then?
Column F, line 21 matches what's on page 1.
Right, but look right under it. It says indicated total value is 21. Then it has rehab exemption, and then we have final value.
Because that's the taxable value. So I should have put taxable value. I apologize for that. So the indicated value is the 10,458,300. The rehab exemption is 1,845,200. So their total taxable value is 8,613,100.
Okay. All right, other questions?
Yeah. Hello, for
Mr.
the
Huff.
appellant. I'm just looking at 2019 income and expense information. There's a management fee of $27,589 on $778,000 of effective gross income, which I calculate to be about 3.5%. Is that a market determined rate, or is that something else? Seems a little high.
What page are you looking at?
Page 348 of 350.
So management fee. So the 27,589. So that's
It's just high for relative to the income on the property.
So it's negotiated with our leasing company that we use. So I don't know too many of the details, but that's, I think, part of how we do business with the management company that we work with. So I think this is part of the contracted fees that we pay them.
Is this bid out, or is it just a?
Yeah, we bid it out every 5 years or so.
All right, Mr. Bailey, do you see 3.5% as being a market management fee for apartment buildings in Arlington?
Yeah, I mean, it's about right. 3.5, honestly, it's like 3.5 to 5%. I know the market properties are around 5%.
Okay. And then I guess one more question while I still got it.
Go ahead.
I remember last year it was the case was made that there was high vacancy on this property, and then it was pointed out that it was under renovation, and it was kind of a big whoopsie. This year we've got the appellant's pro forma numbers for 2020 is 12.6% vacancy, or I'm sorry, 14.74% vacancy for 2020. Is that still due to renovation, or is that just kind of the expected long-term vacancy level for the property?
Sorry, where are you seeing the 14? I'm seeing 12.97%.
Yeah.
But the total with the concessions.
Oh, I see. Yeah, so this is related to the other cases, in that we're appealing based on 2019 valuation and our reported income and expenses. I don't know off the top of my head what expected vacancy we'll expect to see over the long term. I think like 3 to 4% for a smaller property like this is not out of the question. But again, what we're pushing for is evaluating based on actual income and expenses as per the statute, based on the data that we're able to provide the county at the beginning of 2020.
Okay.
Greg, if I may, if you look at the INE that you were looking at, you go to page 346, you'll see that as of 1/1, the vacancy actually was down to 7.4%.
Got it.
Mr. Matskin?
Two questions for the department. First one is exactly taking off of what Mr. Bailey just said. You see the actuals is 7%, and we, in the last case, we like the actuals, we're tending towards actuals. But you put in your test in column F, 3%, which I think is the stabilized value for such properties. And of course, it's exactly what we used for the last case. But why didn't you use 7% this time for this case?
So one thing that's different about this property than the property we just heard is, although both were undergoing renovations or lease up, this property, we had a base value set based off of the rehab exemption. The pre-renovation base value was around 8 million. If I can find my sheet, I apologize. It was around $8 million. Now, so when we looked at this property and we said all the work that was done, you know, in order to qualify for a rehab exemption, it had to increase over the base value by at least 20%. So the first assessment with this rehab exemption in place, the value should be no less than what it was before the renovation, if you're following me. So the property, when we receive the application, we do the inspection. The base value is based off of the tax assessment the year they apply for the rehab exemption. And this is the number we use to determine if the value was increased by 20%. This is standard for rehab exemption. So this property, we took the base value, we calculated the new value based off the changes to the property, any rents that may have changed, and to the cap rate if it changed. So based off these changes, we value the property. So we have the pre-renovation value and the post-renovation value. We take the post-renovation improvement value. You subtract out the pre-renovation improvement value, which is also called the base value, to determine if that 20% increase was achieved. On this property, it did. So the first year of this assessment with rehab exemption in place, it should be no less than that pre-renovation value, if you follow me. So, yeah. So part of it is we said the vacancy is high because of continued renovation during 2019. We expect the property to stabilize in 2020. We use the 3%. And when we come up with our test value, we also compare it to the pre-renovation value.
So it's kind of a test, almost, a test of your test.
Yeah, exactly.
The second question, does the department weight the gross potential income by the amount of units that are for 60% affordable housing versus 50 versus 40, and add those different potential rents even for the same unit? Or is it all just at the 60% level that is prescribed?
I'm glad you brought that up because I was supposed to talk about that. So if you go to page 5, you'll see our test sheet. We break out 1 bedroom, 50% AMI, the number of units that are restricted at this level, and the rents that they pay. We break out the 1 bedroom, 60% AMI, the number of units restricted to this level, and the rents they pay. So you'll see on the test sheet, we account for the different levels of rent restrictions. And if this property reported to us 40% AMI, that would be reflected here as well. They reported 50% AMI and 60% AMI, and that's how we calculated our gross potential income for apartment revenue.
Thanks.
Okay, any other questions? No? Okay, Mr. Bailey, if you take a minute to wrap up.
Okay. This property experienced high vacancy for over the, say, 2 years, but it went over 17 and 19 because partial years due to renovations. The property renovations completed last year. The post renovation was done to account for all the work that was done. There's no way this property should be valued less than the pre-renovation value because of the amount of work put into the building, the money spent put into the building, and then the rents have changed since that time period. Affordable rents have increased slightly over the time period from when this renovation started to when they completed. The rehab exemption in itself is a concession to the vacancy that this property incurred during that time period. It's a 15-year rehab exemption. When we did the rehab exemption calculation, we used stabilized vacancy, the same as we valued this property for 2020. And we think the test is appropriate.
Okay, thank you. Mr. Kinney, if you take a minute to wrap up, please.
Thank you. We're in fundamental disagreement with the county's statement that the pre-renovation value of the property has to be higher than what it was before. Remember that affordable rents do not change depending on the nature of the building. They are set, and if the building is renovated, the rents don't go up. That is not a factor. So we're in a situation that we're looking at income, and the income is how this needs to be valued, not on some assumption that the pre-renovation cost, the renovation costs after renovation have to be higher, which is what effectively the county's answering. If it were a market rate building, I'd understand. Rents would go up. Rents don't go up in this case. They're basically, and once we have the rents in place, that's what determines value. Value could actually go down below what the renovation value is. That's very standard in affordable housing. So some mechanism that says you have to be higher than the post-renovation makes no sense when the statute is very clear. We're looking at income. Income is not affected by renovation in affordable housing. One other thing, we're not in disagreement with the county treating the rents correctly. What we were saying was the expense statements were based on most people building at I'm sorry, it's renovated. Most cases are where the expense statements are showing a figure that is based on a 60% income ratio rather than 50 and 60. Thank you.
All right, thank you, sir. Okay, it's just among the board members.
Well, I'll start. I think whether it changes or not from the previous, the pre-renovation or post-renovation, I don't think it's too relevant at this point. I think we're looking at numbers that are real, that are, according to the guidelines, and they are within what they're achieving right now. So I'm not against the numbers that the county is using in the revised. I'm okay with the way that it was done and the final number.
Mr. Matzkin?
Just on that, Jose, so it's your opinion that in the last case, and these are very, very similar cases, way beyond ownership, that we use the 3% vacancy rate, not because that's what pretty much they're achieving, but rather that's the guideline. And therefore you're applying that same guideline in this case. Is that right?
Right. Yeah, I was in favor of going with the revised assessment in the previous case, but yeah, I'm okay with it.
Okay.
Yeah, what I find in this one different from the first case is that the rehab exemption, was either getting the credit for that, and some of the vacancy is because they were doing the renovations. I believe, if my notes are right, that 14%, I believe Mr. Bailey said, was reported at 7%. So it's obviously coming down as the renovation was finished and it's leasing up. So, you know, on mine, I feel okay with the county's revised number here. What I did is just as my own test, I took the appellant's number in column G, which is pretty similar as far as what they're proposing rents. And then I did stabilize the vacancy at 3% on theirs. And then I took their expenses, which is actually lower than what the county was using. And it actually caps out slightly higher. You know, and I think, again, in this case, that vacancy is offset by the fact that they were doing the renovations and they're getting the tax exemption, the rehab credit on the bottom.
Right.
So, I mean, on this, I'm fine with the revised number. Other thoughts?
Yeah, I thought the revised number was pretty correct. It seems to line up, and I'm fine with the 3% because that is really the value, and it's a stabilized number, and that's what they will achieve, and therefore the value should be in that range based on that.
Yeah, and I think the excess vacancy above that 3 is being addressed in the credit.
That'll disappear.
Anyone else? Mr. Lawson?
Yeah, couple of points. One is on the renovation. I think that's to cover cost of renovation, not vacancy. I'm not 100% sure of that, but that's been my understanding. Greg, on the management fee, I actually thought it was low. And I'm glad I'm not in the management business. These affordable projects, I think, actually require more work on the part of management because you're constantly checking rents and income and making sure people, don't get out of compliance with the regulations. I tried to come up with a way to see if there should be a reduction, and I just didn't come up with one. Thank you.
Okay, anyone else? No?
I'm gonna go ahead and move that we reduce the assessment to the proposed amount of $10,458,300 based on the revised assessment.
Okay, I'll second. A motion and a second by Mary Dooley. All in favor?
Aye.
Aye.
Opposed? Okay, it's unanimous. It's reduced to the county recommendation of the $10,458,300. Okay, so just a question for the board members. Normally, I would say we could wait till after the 3rd, but since we're running a little later, do people need to take the 5-minute break now? Yes?
Yeah, let's go take one right now.
Okay, so it's 10:20, so we'll come back at 10:25 and finish this last case for AFA. All right?
Okay.
Mr. Lawson and Mr. Yates.
I'm back.
Okay. Okay, I believe we've got everybody. Okay, the next case on the agenda is Economic Unit 2304002A, 3507 Columbia Pike. Mr. Kinney, you can start with your 8 minutes and tell us about the property.
Okay. Gilliam Place is actually divided into Gilliam Place East and Gilliam Place West. The county treats them as an economic unit, but I think I will show that they technically really should be treated as separate properties for a number of reasons. We are not disputing the evaluation of Gilliam Place West, the revised evaluation. We're only disputing the evaluation of Gilliam Place East. Gilliam Place East was in lease up during 2019. Gilliam Place West was basically stabilized at that time. Gilliam Place West has 90 units. They are all at 60% of median income. Gilliam Place East has 83 units. They're at 40, 50, and 60% of median income. It's about half and half between the 40 and 50% units and the 60% units. All the units are restricted for 60 years. And Gilliam Place East began leasing in late 2019. What we're asking is that Gilliam Place East be evaluated using the actual income and expenses and the operating expenses. And the operating expenses, we believe, were understated by $47,800 in this particular case. Gilliam Place East also does have a commercial lease. And I think a little history on that is helpful. When the financing of this property was being contemplated, the lender was concerned about these retail spaces. They were required under the zoning ordinance. They're not APAs normally work, but they agreed to effectively guarantee the lease and sublease the property from the affordable housing operator in order to assure the lender that there would not be a negative effect from the retail leases, because it's in an area that has historically been difficult to lease up compared to some of the other areas along Columbia Pike. Basically, there was, because APA basically paid it in 2019, there was $24,447 in commercial rent. I think if there hadn't have been the sublease, there wouldn't be any rent in place. At least one of the places is rented now and will be operating soon. The other place is rented but not paying rent to anybody. So effectively what's happened is APA has guaranteed these at a probably below market rate, but it's guaranteed for the lender purpose. And it can, sometime in the future, we can look at the issue of what the rental should be, but this was done solely to provide the lender assurance that these units wouldn't weight down the affordable project. So one of the things that's interesting and really our main concern here is if you take the assessment of the west property and the east property and you look at them. Now, the west is fully operating, and that's assessed under the revised numbers suggested by the county at $118,322. East, which is still under renovation, I mean, not under renovation, still under lease up, is assessed at $237,851. So they're assessing the east building, which does have which they're claiming a little over $2 million in value for the retail, and we're claiming that the value should be based on the lease, which is at least a guidance for now of about 655. But the valuation of the East building is it actually is double that of the West, and West is the stabilized unit. So this shows some of the problems with not using actual rent and expenses. And that is where our disparity comes in, just how you can assess East with larger vacancies, lower income, because they are the ones that have the 40, 50, and 60% income at 237,851 a unit, and you assess West at 118,322. So that is the disparity between two neighboring properties that we basically don't understand and are contesting. Thank you.
Okay, thank you, sir. Mr. Bailey.
Yes. I think first, for clarification, this property again is valued as one project. It has two parcels which the project sit on, but it's valued as one project. So if you look at our page 4, I believe it is, no, page 5, you'll see the test sheet, which corresponds to the test column in on page 4. We look at the units based off of their restrictions. So for efficiencies, we have 5 efficiencies that are restricted at 50% AMI. We have 17 efficiencies restricted at 6% AMI. We don't separate out by building, East or West. We go off of the units and we value it as one project. So with that being said, this property was treated the same as we treat all new construction projects. We calculated the revenue based off of the units and the restrictions and the rents for each restriction type. We applied a 3% vacancy for stabilized vacancy, and expenses. You'll see that on our page 4 as well. This is a new building. We inspected this property late last year, Chris Chikas and myself, to do an inspection to see, what amenities did this building have, what finishes did the building have, what did the retail space look like, and things of those nature, and talk to whoever's available in the leasing office. Based off the information, we valued the property for 2020. Again, it is a brand new building. It began leasing up in 2019, but the first full year lease up would be 2020. So we deducted a 12-month lease up deduction below the line based off of this building being a brand new building. We applied the 12-month lease up deduction to the residential portion and the commercial portion. So looking at page 4, we receive additional information from the owners, which is the 2019 INE. You can see they reported actual revenue that they could achieve. I'm assuming for one building because it's pretty low compared to the pro forma. If you look at line 1 in column E and line 1 in column G. The building reported a negative NOI, so I think it's obvious why we wouldn't use the actual 2019 information to value this property. We did make increases. No, we decreased the revenue based off of the new rent matrix that was supplied to us by the owner with the 2019 INE. We reduced the residential portion based off this new information. Again, we applied the guideline vacancy at 3%. We applied guideline expenses and the cap rate appropriate for this building. And you can see on page 4, in each column F, the first one being for apartments and the second one being for retail, we applied the guidelines that fit that use. So the retail guidelines would have retail vacancy and expenses and retail cap rate, and coming up with our value for this property. We offered a reduced value from the original $35,133,900 to $30,390,700. The owners rejected this offer, and that's why we're here before the board. I think that's pretty much all we have for this property. If you look at the owner's packet, I mean, again, you look at the cost that they say it took to build this building and then our income approach. I mean, we're definitely taking low income rents and restrictions in place. The total cost value that they reported in the packet is around $60,758,693. And here we are using the income approach at a reduced value of $30,390,700. I think another thing to point out is Gilliam Place East, as they call it, the vacancy for last year was 49%. That's reported on the INE, but as of 1/1, it's 0%. So it shows how quickly the affordable properties lease up, and you still compare that to the 12-month deduction that we allow below the line. That's pretty much all I have. If you have any questions, I'm here to answer.
Okay, questions from board members? I'll just ask one easy one to start. Mr. Bailey, so when you come up with the revised amount and even the original assessment, how do you break it up per parcel?
So when we got the initial site plan for this property, we tried to, I think you look at it, you can see how many units per parcel. So on the worksheet that we have, one parcel has 90 units, and I think the other parcel has 84 units based off of what was allowed by the site plan.
Okay, and then Mr. Kinney, my question, why don't you report the commercial portion separate from the residential? Or that may be from Mr. Root.
Probably from Mr. Root.
That would be for me, yeah. So in reporting separate, how do you mean?
Well, break it out. I mean, because obviously it's a different cap rate. It's a different, there's different expenses associated with that.
So I think we have it broken out on, let me see here. Sorry, all the page numbers are different here. This is page 57, it looks like. Yeah, page 57. We have it broken out below the line on line 24, column F, page 57. So that's the amount that we are applying for the retail space. So it's the 677,000 number.
All right.
Does that answer your question?
Yep, I'll go take a look at that. And I think Mr. Hoffman, you raised your hand. Do you have a question?
Yeah. Just the number that jumped out initially to me is is line 18 operating expenses from the appellant on a per unit basis, especially for a new building. I think Mr. Bailey mentioned it. It seems extremely high. I noticed there's a leasing commission line item in the INE. Is there anything that's kind of a one-time expense that might be in there, or is that number in line 18? Is that the expected annual operating expenses for this property?
Sorry, I'm just taking a look real quick.
Yeah. I mean, we don't usually see anything on new buildings that's going to be that high.
So in terms of percentage, or
something over almost 9,000 per unit on a operating expenses seems pretty high that's excluding taxes.
Mm-hmm. It is excluding taxes. So I think the expense ratio that we're using based on the appeal, column G, is 37% for the economic unit as a whole. which isn't out of line with how most of our properties operate. We usually hit around 37 to 43%, somewhere around there, expense ratios, sometimes higher depending on the property.
You know
So
what?
that
Maybe
does-
I might have gotten mixed up between the east and west and the total number of units there.
Well, and I'll just add here, just so this doesn't become an issue. The county on the original assessment and on the test is even higher than what the appellant is, suggesting. So I don't really think that's an issue overall. Okay, Mr. Lawson, I think you had a question?
Yeah, how much income was derived from retail?
So I believe, sorry, there's a lot of different pages I'm flipping back and forth, as you guys know. It was 24, where is it?
447.
24,447 for 2019, and that's with, so both the leasing spaces are being leased out to nonprofits. One is to Arlen's Presbyterian Church, the other is to a nonprofit group called La Cucina, and so that income, I believe, was just for the APC portion, because there's no income coming in for the other one. Sorry, what was that?
The retail space is partially used by the church.
Yeah, so there's a 3,500 square foot portion that is occupied by the church, and the church is paying rent on that space. APC is the church that we partnered with to get this building built in the first place.
Right. That was the original deal.
Mm-hmm.
The 24,000, was that for the whole year?
I don't believe so, but I can double check that. So yeah, I think that was only for part of the year.
That's what I thought, yeah.
Okay, Mr. Metzgen?
To dovetail on that, for the department, the $240,000 you have in gross potential income from retail, is that based on estimated or average rents in the Columbia Pike corridor? And just knowing that this really isn't these retail spaces really aren't being used for traditional retail, does that matter?
Those are based off of rents that we see in the Columbia Pike corridor. We try to use the lower end. We didn't have any rental information for the property on the original assessment, and that's what we relied on.
$30 a square foot. Okay, good.
Question for the applicant. How much is the church paying rent?
The church? So I believe the church is paying to the LLC that governs the space. I believe it's $15 per square foot, with a $5 per square foot maintenance fee. So because it's per month. Yeah.
And that's part of the deal. My recollection is the church sold it to you guys, and they took back the space, and that's a long-term lease arrangement. Is that right?
There's a lease in place. I don't know if there's a specific date of expiration, but they have the space, I think, for a number of years with a specific rent calculation that goes along with it.
Yeah, that's kind of what I think this case kind of boils down to that. What is the actual income to be derived from the quote retail versus what the county estimated?
Okay, other questions? No? Okay, Mr. Bailey, if you take a minute to wrap up.
For this property, we valued it the same as we value all new construction properties in the county. We used the information that we had on hand to develop the 2020 assessment. We applied a 12-month lease-up deduction to the apartment portion based off the rents that we use. We also applied a 12-month lease-up deduction to the commercial portion based off of the rents that we use. When we received the 2019 INE, we made adjustments to our revenue projections based off of the rent matrix that was supplied. Again, we applied 12-month lease up deduction below the line based off of this rent revenue that we calculated on our test. And the commercial portion wasn't changed, but again, the 12-month lease up deduction is based off of the $30 a square foot used to calculate that potential retail revenue. We believe that the test or the offered reduction is fair and equitable, and that is a value of $30,390,700. That's all. Thank you.
Okay, thank you. Mr. Kinney, if you take a minute to wrap up, please.
Thank you. I think what we see here is quite a disparity between the West building, which is in place, active at 118,000 a unit, at the East building, which has fewer units and lower income, and it's at 237,851. If you subtract out $2 million, if you subtract out 20,000 a unit, or 1.6 million, which is the approximate difference between the rental the county's showing on the commercial and the rental we're showing, it is still over 200,000 a unit, and there is no basis for assessing one that is operating at 118 and the other at 200, which is based on speculation on what the rent would be. In this case, we have a good comparable right next door. The county does break them out by RPC, so you can look at the difference. And that's our base.
Okay, thank you, sir. All right, it's just among the board members. I guess I'll just initially start. My concern, I hear what the appellant is saying about the two parcels, but the parcels are combined into an economic unit. It sounds like, and that's why I asked initially, with the assessment and the reduced assessment, revised assessment, it's somewhat an arbitrary system that they just put so much on each parcel, but it's not broken down that way. So unless they were going to split the two parcels, you know, and then we were strictly looking at East versus West, I think that there would be more of an argument that you can't compare one over the other. I think the total amount is for both. And so I'm struggling with trying to say, well, one half is done well and one half isn't. I don't know what other people think about that.
Yeah, Mary.
I agree with you on that, Mary.
Go ahead.
To me, it looks like one building. It feels like one building. I assume somebody goes into the leasing office and fills out the application. They don't choose their unit. They kind of get put into one unit versus the other. And so it sounds like they're trying to fill up one, you know, legally constructed component first for some reason. And it doesn't necessarily mean that the second portion of the building is less valuable.
Mm-hmm. Okay, okay, go ahead, Mr. Lawson.
I think where I am is the apartment looked okay on the revision, but I think the commercial is way overstated, is way overvalued.
Well, the county used a market rate, and the fact that they're leasing it out to the nonprofits and related entities somewhat at half the market value, that's their choice.
No, it's part of the original deal, Mark, because when the church, remember this was church property, so they sold it to the affordable housing, and as part of the deal, the rent was set for a period of time. I think on the other, where they're leasing to the nonprofit, you're right, that's their choice. But I think the portion leased to the church, I think the county has to look at the actual arrangement.
Do you recall what the term of that agreement is?
No, the applicant doesn't. They didn't anticipate this direction.
The church is in a small component of the space. It's not the whole space, right?
Right.
Mm-hmm.
I think there's two other tenants.
I don't know. I think the affordable is going to go to a stabilized number, and it's actually from what January 1 is. It's there and better, and they're leasing below market rates for the retail space by choice. I think the county's correct.
Yeah, I would agree on this. When I look at the appellant's pro forma, I mean, the numbers are almost identical. I mean, in fact, they're actually slightly higher. If you look at the GPI on line 7, they're a couple $100 higher. The difference here is that they're, looking at, the larger vacancy. But as was reported, it was, in the one building it was 49%, and it went to zero, I guess, as of 1/1.
Yeah.
I feel like in this case, I mean, I'm always the first one to jump on for the affordable housing. I don't think the case is made here. That I look at what the revised assessment is when I take the appellant's number in column G and just apply the 3% like we did on the other ones. It ends up assessing higher than the county's reduced number. So I'm kind of struggling with that. I mean, I think they're in agreement on the expenses are high. They're being more than fair. Looking at the actual expenses, they're given higher than what they're projecting and higher than what was reported. So in this instance, I don't know. I seem to think that the county revised number is a good one.
I agree.
I agree. I think the original reaction I had was that, they're just trying to divide West and East and, because it's a little more convenient. But, we're going to look at the whole thing. And once it's reassessed or revised or appealed, and, we look at the whole thing, not just portions of it. So I'm okay with the revised.
Mary, I think you were right when you suggested to the applicant in the future, they probably ought to break it down the way the county did into the retail and the apartments.
Mm-hmm. Okay, well, if that being said, then I'm going to move to accept the county's revised number of $30,390,700.
I'll second.
Okay, motion and a second by Mark Yates. All in favor? Aye. Opposed? Okay. You're opposed? Okay. 6-1 with no Mr. Lawson. Okay, the assessment has been set at the county revised number at $30,390,700. All righty, next up.
Thank you.
I don't know what's just happened here. I have a pig on my screen. Who's got the pig up?
It's not my pig.
Somebody's sharing the screen. They have to stop sharing.
Okay. Okay. Next on the agenda is Economic Unit 1802503G, which is the North Fillmore Street. And I understand that we've been asked to accept a withdrawal on that. Is there any objection from the county?
No.
Okay, then I will move to accept the withdrawal. Do I have a second?
I'll second.
Okay, Mary Hogan is a second. All in favor for the withdrawal?
Aye.
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 Opposed? Okay, I can't see everybody, but I don't hear anybody saying no, so I assume it's 7-0, the withdrawal is accepted. Okay, the shared screen. Thank you. There we go. Okay. All right, the last case for today for consideration is RPC 1603008 at 2055 Wilson Boulevard. Is Mr. Kapnick on the call?
Yes, I am.
Okay. Oh, perfect. Okay. Mr. Kapnick, you can start with your 8 minutes and tell us about your property.
All right, I'm on the call today about 2055 Wilson Boulevard. It is the Brooklyn Bagel Sandwich Shop that's right across from the courthouse. This tenant has been with us going on 21 years now, and he has extensions that'll take him all the way to March 31st, 2039. The nature of his lease was to have rental increases based on CPI. So we've been limited as to how much we can increase his rent. I guess the other issue that I was going to bring up was that after talking with Lori Roskine, who was really kind in explaining a lot of this to me, she let me know that the cap rate was 7%, which based on last year's rental income would make the property worth $973,842 to the best of my knowledge. We're a small company. I wish I knew more to say to take up the 8 minutes, but I'm sorry. I'm just I'm new to this and appreciate any assistance and help you might be able to give me here.
Okay. Thank you. Ms. Ruskin?
Thank you, Board. Basically, we went out and inspected the property this year, earlier in the year, and just to get a good understanding of how the premises are used. And after the inspection and reviewing the 4-year history, the department feels that our original assessment is in line. I will not disclose any numbers as this BOE hearing is being viewed live on the internet. But when you look at column D, line 21, which is the original assessment, the NOI that we're using is less than what is being reported for the operating year 2019 under column B, line 21. Otherwise, we feel that the assessment is reasonable. I'm finished. Thank you.
Okay, thank you. Questions from board members? Mr. Lawson.
Yes, ma'am. This is for the applicant.
Yes.
Is this a triple net lease that the tenant is responsible for taxes, insurance, et cetera, and also maintenance of the property?
They are. It is a triple net lease. They are responsible for the property taxes. However, the exterior of the building we do maintain. Yeah, I'm sorry. I hope I answered your question.
What I see, the county's estimating your expenses at around $10,000, $12,000. Is that accurate?
Let me just double check, but I believe that's. Sorry to take up your time.
No, that's what we're here for.
Thank you. Yes, that's correct. I'm showing about 13,500 expenses.
Are you not giving the county income and expense statements?
So I'll be honest with you, and I'm sorry to share bad news. My father owned this property, and he just passed in February. So I had to get a lot of this information over to Ms. Roskine in a short time while we were unfortunately mourning and grieving. So I know he's been sick previous years and he had an issue getting the paperwork over to you guys, but I'm hopeful being the next generation that I can stay up to par and get you guys whatever you need.
Okay, that's the only issue that I saw was that, there should be some expenses even with a triple net. And
right.
In the future, maybe focus on that.
Yes, sir.
Okay, any other questions? Mr. Metzgen.
For Mr. Kapnick, you had a discussion with the department, Ms. Roskin, and she gave you some insights on how they do stuff in terms of assessing properties. And you, by definition, because you're here, disagree with what you heard and have set your, and this is a directly related second question, or question 1A, you've set the value of your property, I don't know, 8% less or something. What is it that you didn't hear that convinced you the department was right? And what is your determination of what, how did you arrive at the determination of what you think the assessed value ought to be?
I appreciate you asking that. So yes, the information that Ms. Roskine gave me was very valuable. It was new to me. We actually manage some property in Maryland as well that we do use the CPI and property value approach based on other properties sold around it. The income approach is something new to me, and unfortunately I was just completely unaware. Based on what I was able to find on the income approach, though, it was the rental amount divided by the capitalization rate, which is how I came up with the 973,842.
Okay, I have a question. Mr. Kepnick, have you looked at the I&E summary that the county provided in the pack?
Is that the one that, excuse my negligence, I'm sorry, is this the one that's computer typed in a few different colors? I had a chance to briefly look over it. I was hoping that my attorney was going to help me decipher some of it, but no, to be honest with you, I hadn't really had a chance.
Okay, well, that's unfortunate. Okay. Any further questions? Mr. Metzgen.
Back to the department on page 1, in the assessment values, the 2019 values are for land and building are exactly the same as 2020, but the total is less. And such that, so what, you missed a number on land and or building for 2019. But and I don't need to know what those numbers are as long as you stand by the total in 2019 being accurate. Is that right?
Can you give me just a moment and I'll flip
Sure.
to the web page real quick?
It's the front, it's page 1 of 68 for us.
Right, I'm going to confirm it with the public web page that I submitted in the packet. That's on page 6. So on page 6, I see what the issue is. For page 1, 2019, the building number is being reported incorrectly there. It should actually be 525,300.
Okay. And I know that in commercial, you're not, of course, assessing separately, definitively, land versus building. You just divide it via the income approach. So what that does, in truth, create an 18% assessment increase in 2019 to 20, about 18%. So I'm assuming that's why the appellant is here, not knowing that that's not an unusually high increase for retail, especially in Arlington, especially along the Metro line. Now for 2021, that may change based on our situation. But I just wanted you to go on record that, what the true number was and what it's become. So thank you.
Thank you.
Okay. Any final questions from board members?
I have one.
Okay.
Just brief. The appellant, you mentioned the rent was based on CPI and going back, but how far did you say it was going forward based on that?
So the tenant came in 1999 to sign the lease, and his lease is up in 2039. So unfortunately, our lease does prohibit us from increasing his rental amounts too much.
Okay.
Okay. Ms. Roskin, if you take a minute to wrap up, please.
Thank you. Once again, I'd like you to refer to page 3, the study page. Our original assessment, when you look at the rent, it is less than what they're reporting for 2019. And you go further down the line and take a look at the EGI, it's considerably less than what's being reported for the 2019. Although the expenses are a little bit less than what's reported for 19, it's a good middle of the road number when you look over the 4 years. Ultimately, when you refer to D line 21, our NOI that we're using is substantially less than what's being reported for the 2019, and it's less than the NOIs that are being reported for columns A, B, and C. I'm just asking that you confirm the original assessment. Thank you.
Okay, Mr. Kapnick, if you take a minute to wrap up, please. Can you turn your microphone on, please?
Thank you. Sorry about that. I really appreciate you guys' time today. Thank you so much, and appreciate all your expertise, Ms. Roskine. Thank you. This has been a definite learning experience for me. I guess I'll end today by just asking that the situation with Brooklyn Bagel and their long-term lease just seems to be kind of unique in the sense that we don't have the ability to grow. My biggest concern is that the tax payments get to a point where our tenant can't pay and then we lose him. And then, you know, I'm sure life goes on, we'll find another tenant. Just would like to keep the tenant where he is, since he has been with us for a long time and has plans to stay with us for a long time. Also on the cap rate, from what I was to understand, was the total amount divided by the capitalization rate. So that's what I was to understand. But again, I do appreciate your time today. Thank you.
Okay, thank you. Okay, it's just now among the board members. Mr. Metzgen.
I see, excuse me, I thought the 1 minute wrap up from the department hit all the right points. The rent is lower, the vacancy rate is up, even though it's only one tenant. The operating expenses are down. So the issue is a cap rate issue. Arlington retail had a pretty good year last year, and the cap rate fell, and so the value goes up. And that's no one's fault. That's the way it is in our atmosphere at mass appraisal. And it seems, therefore, that this is an equitable and fair assessment to me.
Yeah, I would agree. I mean, I look at, you know, unfortunately, the situation that brings the appellant with the death of his father, although very sad, I don't feel with the burden of proof on the appellant that there was any case made. I mean, when you look at the estimate that he's looking at, the 972, that creates an NOI that's 10,000 below the assessment, and the assessment is below the last 4 years. So, I mean, if anything, the property's underassessed. You know, so I see nowhere to go on this but to confirm the county.
I agree.
I agree. I think this, you know, it's, in my opinion, it's undervalued. Even if we were to use the actual operating NOI, the operating income, which I think it's at a level that it should be, you know, the value would be more than $1.1 million. So I'm okay the way it is right now.
Anyone else?
No.
All right, then I'll move to confirm the county at the $1,035,300.
Second.
Who's second? Mary. Okay, Mary Hogan. Okay, all in favor?
Aye.
Opposed? Okay, it's unanimous. The county's confirmed at the $1,035,300.
Thank you, everybody, for your time today. I'm very grateful.
Thank you.
Thank you.
Thank you, board. Have a great day.
Thank you. Mary, before we go, could you tell me who seconded the previous case?
On the withdrawal,
Yes.
it was, second was Mary Hogan.
Okay.
Okay, before everyone goes, we do have some, everybody got yesterday. I just want to make sure I pull this up properly. 3 cases that they've filed late.
Thank you.
Okay, so the first one we're looking at is I'm sorry, I'm waiting for it to open. Okay, the first one is RPC 09066-017 at 110 North Kenilworth. I mean, what's everybody think about these?
Well, we haven't let others file late, and I didn't see any justification as to why this was filed late. So I think it would be unfair to others who we have not allowed to file late to let this filing. So I would oppose it.
I agree. I think there's really no basis to accept any appeal on this, all three cases actually, but yeah, we'll deal with this first.
Yeah.
Okay, somebody want to make a motion?
So moved.
Okay, do I have a second?
Second.
Second.
Okay, Barnes and Jose, all in favor to not accept it?
Aye.
Aye.
Sorry.
Okay, 7-0. Okay, the second one,
Same thing.
Same thing.
it's the same RPC number.
But the address is different.
Okay, so Rosa, you'll fix the RPC numbers?
Yes, ma'am.
So this is 1100 Kenilworth. Okay, same issues. Do I have a motion, Mr. Lawson?
So moved.
Okay, motion, second.
A second.
Okay, Jose, all in favor?
Aye.
Opposed? Okay, and the third one?
Same thing. I'll move that we not accept the late filing.
Okay, that's 090700003. So we have Mr. Lawson, second.
I'll second that.
Okay, keeps it nice and tidy. Everybody, all in favor?
Aye.
Aye. Opposed? Okay. 7-0, it's unanimous on all three. We don't accept the postponements.
I think the reason being that they gave no reason for the,
Right.
yeah, not filing.
Right. Okay. Does anybody else have any other business? No? Then
No.
we will adjourn now at 11:13 and re-adjourn tomorrow, July 8th at 9 p.m. Thanks,
Okay.
everybody.
See y'all tomorrow.
All righty, bye-bye.
Tomorrow.
Thank you.